So last week delivered two major developments that shook financial markets. One from government policy and the other from market infrastructure. Both events caused uncertainty, volatility, and raised serious questions about how fragile key parts of the system can be. So I'm going to walk you through what happened with the UK budget leak last week, how markets reacted, and then move on to the CME outage, which temporarily froze large parts of global futures trading, a huge event. So let's start with the UK. Now, the government was preparing to unveil its autumn budget, and as usual, markets were waiting for the official speech in Parliament. But for the first time in years, there was a serious breach of protocol. Now, over 40 minutes before the Chancellor stood up to deliver the speech, the Office for Budget Responsibility, or the OBR, accidentally published its full economic and fiscal outlook online. This document contains all the core assumptions and fiscal projections that underpin the budget. So in effect, the market got the headlines before Parliament did. Now, the second major story came from the US, and it was operational rather than political. The CME Group, or Chicago Mercantile Exchange Group, the world's largest futures exchange, experienced a major outage after a cooling failure at a third-party data center. As a result, trading in key futures and options markets, including equity index futures, treasury futures, FX commodities, and agricultural contracts, was all halted for around 10 hours. This really couldn't have happened at a more delicate time because it followed the Thanksgiving holiday when liquidity was already thinner than usual across the markets. The outage meant that brokers, hedge funds, market makers, and liquidity providers suddenly lost access to one of the world's main price discovery engines. Now, futures markets help set expectations for everything from interest rates to equity market opens. Without them, firms struggled to hedge, couldn't update risk positions, and in some cases had to halt client execution. This was a global problem. Some brokers even froze trading in affected products. Others relied on internal models or alternative venues to provide indicative prices, but these were less reliable and carried additional risk. It was a no-win scenario for everyone. Okay, so let's take a look at the charts here. Now, as soon as the numbers were released by the OBR, accidentally 40 minutes before the budget statement, traders reacted. Bond markets moved immediately and the pound shifted, and positioning quickly adjusted ahead of the formal announcement. You can see here on the 4-hour time frame, we had a very indecisive spike. Now, previously, the day before, we'd pushed into a clear area of supply and the market had reacted to the downside, but the overall incentive of this market was clearly bullish on the lower time frames. That initial spike there looked like it could just be grabbing some liquidity and coming back down, but what followed was the actual budget announcement, and prices then rallied. When something like this happens in the market, it often leaves uncertainty, and uncertainty isn't necessarily good for markets. We've all heard the statement, buy the rumor, sell the news. But in this scenario, the market rallied on the rumor, sold off just before the news, and then resumed its trend to the upside as the budget announcement was released. Now, this sudden timing mismatch created a burst of volatility because investors were trading off leaked information, but the official narrative was still not public. The OBR apologized and launched an internal investigation, but the damage had been done. The surprise element that usually accompanies a budget had evaporated. Now, once the full budget was delivered, markets had more time to digest. The government announced a range of tax increases and fiscal drag measures, most notably freezing income tax thresholds. This means as wages rise, more people are automatically pushed into higher tax bands. There were also changes affecting pensions, ISAs, savings income, and property taxes. Many of these measures are backloaded, meaning the projected benefits show up further in the future. Now, because of that, some analysts questioned whether the long-term targets were realistic and whether the government could genuinely deliver the fiscal tightening it promised. So let's take a look at how the CME outage affected markets. Now, you can see here from this liquidity provider, there was a huge spike to the downside on this gold 30-minute candle. But if we look at other brokers or other liquidity providers, price was reflected very differently. You can see the difference in size of candle here, and actually the whole market structure looks completely different from one broker to the other. This really showed how dependent global markets are on a very small number of data center operators, and how even a technical fault, something as simple as a cooling failure, can freeze major financial markets worldwide. It also reminded everyone that operational risk can be just as disruptive as economic or geopolitical. For many firms, this will likely trigger internal reviews about redundancy, failover capabilities, and how prepared they really are when a core part of the system goes down. Now, the bigger point is what this outage revealed. It showed how dependent global markets are on a very small number of data center operators, and how even a technical fault, something as simple as a cooling failure, can freeze major financial markets worldwide.